Here we have the typical account titles that you will find in an income statement. Now, an income statement shows the revenues and the expenses of an organization as of a span. It's actually of a span of time, like for 1 year. You can have an income statement for any period of time, actually, but it's very common to show it for a year, for a whole operating cycle. So you could have an income statement as of the end of a year, but what it would really be would be the preceding 12 months. Could be the 12 months leading up to December 31st, an income statement for that. In any event, it shows the revenues, it subtracts out the expenses, and what you're left with is either net income or net loss. On this slide here, we see the typical account titles that you find in an income statement. So under the revenue section, you will possibly see sales revenue, fee revenue, interest revenue, or rent revenue. And we will, as the semester plays out, define these and work with these different types of revenues. But sales revenue is an easy one to understand. Think of a retail store. You go in and you buy something from the store. That sale is revenue for that organization. It's how they earn their money, basically, how they make their profits by selling things. Fees are usually charged for services. Interest is charged for the use of money. And rent is charged for the use of a space in a building, or for the use of a piece of equipment. The expenses that we typically see on an income statement are things like cost of goods sold, wages, rent, interest, depreciation, advertising, insurance, repair expense, and income tax expense. And there are other expenses, but those are very typical. Now again, like I have told students in the past regarding other financial statements, with the income statement here in this particular slide, what you have is a bunch of vocabulary terms, and you have to at some point know what each one of these items means. Here's an example of an income statement. Look at the very top right hand corner of this slide. You see basically the formula for the statement. It is revenues minus expenses equals net income. On this exhibit, we see that the company's name is MaxiDrive Corporation, or MaxiDrive Corp. The type of statement is the income statement, and that always goes second. You have the company name first, the name of the report comes next, the income statement. And here we see that it's for the period of time. It's always a span of time with the income statement for the year ended December 31st, 2010. The report, or the numbers at least, are in thousands of dollars. And we see that this company had sales revenue, total revenue of $37,436,000. Remember, you got to add 3 zeros to the end of the numbers that you see here because the amounts are expressed in thousands of dollars. Next comes the expenses, and you have the cost of goods sold expense first. That's the cost of those sales revenues. In other words, it's if that's merchandise, I assume that they're selling, that's the cost of that merchandise, or cost of that product that was sold. So the $37,436,000 of product that was sold at its sales price cost the company $26,980,000 to acquire, put on the shelf. There are selling, general, and administrative expenses of $3,624,000. And you go right down the line, you see all these other expenses, research and development, interest expense, and so on. The total expenses are $33,036,000. Now those are less than the total revenues, and that's where the operating income item comes from. The operating income for this company is $4,400,000. So they are making money, but what we have not accounted for yet on this report, as we move down this report, is income taxes. And income taxes come next. They are subtracted after operating income. The income taxes for this company were $1,100,000. So the final figure, the final bottom line for this report is net income of $3,300,000. So we say that MaxiDrive Corporation, for that 12-month period that ended on December 31st, 2010, were profitable. They had net income, and that net income is available for the owners of that business. The stockholders might decide to reinvest it in the business, keep it in the business, or they may pay out all of it or some portion of it in the form of dividends to the owners, who are the stockholders of that company. The next formula we see is that of the statement of retained earnings, and that is the beginning retained earnings of the business, which are reported on the balance sheet, plus the net income for the period, less the dividends, equals the ending retained earnings. And here's an example of what that report would look like. It just shows the amount of earnings that the company kept during the course of the year. It's increased by net income, it's decreased by dividends, and again, that number, you'll see this in some of the exercises we do, that final number would be reported on the balance sheet.